exactly the same, and that's the way it's supposed to go when I'm doing it. You know, it's fine, except Christmas, it's okay, I guess, because Christmas is not a big deal in Japan, and it sort of meets that, but they don't have a different one in that. So you'll see different ones, but in the US, do. So it's important to have a fiscal year if you really want to see what's going on. Okay, now, all right, sales. For all you deal with government contractors, this is sort of an issue about doing it. So what sales can I count? If you're a firm, what sales can you count? You would think, oh, if I have whatever I sold during the year, that's my total sales. I can report as my income for the year. The answer is not really. In the case of a supermarket, it is, because if you buy stuff at the supermarket, the transaction is complete when you walk out the door and you're done. They've given you what you paid for it, you've done it, get what they've done. But here's the classic example of this. Suppose that, I know you all have done this. Suppose that one of your neighbor's children come to your door and say, we're selling magazine subscriptions. All right, and we're selling you can buy it January, make it easy, so it's like January 1, and you buy a 2-year subscription to The Economist. And you pay $279 on January 1, they cash the check, it's done, okay? So they got $279. The Economist cannot recognize an income in the year 2019 for the full amount. They got the money, but they can't recognize the full amount, because you can only recognize things once you complete the transaction. So the first year, they can only recognize, they've delivered the first year of a 2-year subscription. First year, all they can do is recognize the revenue for, okay, 1/2 of that. And it comes the next year. So, if you all worked out there, you understand is that here it's defining what you've completed in terms of the transaction is easy. If you deliver 12 magazines, 12 out of the 24, you're all set. Think about a contractor with the government. You know, how much can they recognize? Andrew's saying, is it a problem, Andrew?
I work as a core on like 5 contracts for the lab, and it is a pain having to deal with what money we can pay for because they've completed the work. There's money that we have that we can't use because they haven't completed the work
Right.
for it, but we have to have that money set aside, so when they do, we can pay for it.
Yeah. But okay, but so it turns out, this is one of those things, you sort of think about accounting, it's sort of like very rule-based, everybody, but there's this area about how much you can recognize, okay, of a contract at any point in time, or how much you can bill the government for, and once you bill it, you can take it as revenue. But there's a wide area in which firms, let's put it this way, what's the bias of firms? What do the companies want to do?
Report as well.
Yeah, Caroline?
They want to get their cash flow high at the beginning.
Yeah, sooner is better.
Yeah.
Okay, sooner is better. So the tension between a lot of the government and contractors is say, oh, well, you owe us for 60% of what's been done, and you look and say, well, I only see 30%. Okay, and this is sort of, so it becomes an issue about how much you get. So there's a lot of wiggle room in that doing it. Pat?
Doesn't revenue and cash flow really, it's not the same thing. You can book revenue,
Right.
but you might not get the cash flow for it until you deliver. So
Exactly. We're going to go down here and sort of look at cost of goods sold. Just let me get to the end here, and we'll sort of, your point is, when we get to the end here, Pat, is that net income is not the same as cash. Okay, in fact, it could be very different than cash. All right, and so for a finance person, I'm all about cash. Okay, you worry about what your cash flow is going to be, but this measures how you do. so cost of goods sold, okay, cost of acquiring what you sell. So basic equation is cost of, what do you have, what do you have on the shelves, okay, at the beginning of the year? What did you purchase, and what do you have at the minus what you have at the end? That difference between the two things is the cost of goods sold. All right, and so basically, pretty simple measure, but it can be very complicated. And it's sort of, think about cost of goods sold generally is variable cost. It's not fixed cost. All right, but there's a big question about how much is variable, how much is fixed. All right, so cost of goods sold, and when I refer to cost of goods sold, you make you good finance people, it's often referred to as COGS. Okay, so you have somebody say COGS, it's cost of goods sold. I mean, there's a lot of, one of the biggest challenges that people have coming into any sort of program is that each field has its own jargon. Okay, I am sure the folks here who have been in the Navy or doing, you have your own jargon that explains everything to people on the other side when you're talking to them, but you have no clue as to somebody listening to. And the classic is that I went to lunch with one of my marketing friends, and she basically was talking about scanner data. And I have no idea what this is. The data they collect when they scan your goods at the supermarket, or you do the scanning. It's, you know, it's a big deal for them to collect data about for you and doing it. So I had no idea. It's jargon. All right. So, okay, then we have SG&A, sales, general, just operating costs. What it tends to be is includes salaries for different things, not people who make stuff, but people who sell stuff and that. So it's just sales, general, and administrative. All right, and so that's pretty much generally what you do. All right, let's look at EBI. Let's look at depreciation. We'll talk more about this later, especially this afternoon, a little bit later, this early part of it. This is the charge used to account for what you've used up of an asset's value. Okay, so if you buy something for $100,000, your company, and you say, oh, it's got a 10-year life, so $100,000, 10-year life, okay, and you're going to depreciate a straight line. That means over equal amounts over 10 years. So basically, you would deduct $10,000 a year every year, okay, for 10 years. But is it a cash expense? This gets back to Pat's point. Is it a cash expense? No, it's just a paper transaction. Okay, it doesn't actually. It's no cash going out, but it's a way of accounting for the fact that you've used up some of the value of your assets. All right, and so then we go down here. So if we take sales minus cost of goods sold minus SG&A, that's the other thing, jargon on that one, depreciation, take those differences. That gets you earnings before interest and taxes. EBIT. We're great on having a little jargon here. EBIT. Earnings before interest and taxes. All right? It's a measure of operating profit. Okay, it's a non-cash, but it's a measure of operating profit. All right, so if you could compare that for two firms in the same industry, it will tell you what they're, taking into account their operations and what. So that's EBIT. Next, you take out interest expense. That's what you pay. Finally, then you get profit before taxes, take out taxes, and you get to net income. But simply the fact that depreciation is a non-cash expense, what that means is, in point of fact, that net income is not cash. It's not what comes in as cash. That's sort of an accounting profit that takes into account. And we'll see some other things. Yeah.
I'm sorry, so can you say, what do you mean again by like a cash expense versus a non-cash expense?
Okay, let's sort of do it this way. Most of the time, so all of your expenses are what? Think about it think about this in terms of what your taxable income is.
Uh-huh.
Okay, that basically you get taxed, if you could take out your mortgage payment, all this other stuff, those are all, you pay cash, you pay those right now.
Yeah.
But suppose that what you had was depreciation, there's something you could depreciate, that reduces your taxable income, but it's not real cash. Okay, you get to deduct it, but you haven't paid anything yet, okay?
Okay.
All right, and so when you start looking at net income here, it's the deduction that reduces the taxable income amount that you pay taxes on. But you really didn't, that's not cash out the door.
It's not like a bill you paid.
Right,
Yeah.
and so if you sort of think about it in this way, okay, but the other thing is, so you get down to net income, okay? Earnings before interest, a measure of operating profit. But there's also this thing that's called EBITDA, where you take earnings before interest and taxes and add back depreciation, because it's a non-cash expense, so it's a measure of cash flow. Okay, because you're adding back the non-cash expenses. So it's a rough measure, Sonia, of operating cash flow. Okay, and if you ever have the privilege, the opportunity, or the to interact with investment bankers, they love EBITDA. It's a measure of operating profit after tax, operating cash flow. All right. So two things come away from here, which is that net income's not the same as cash. It's not cash flow. Okay. And so that's the key thing here. So, and sales, you may not have collected all of those revenues. Okay. So, that's not necessary. So we'll look at that.